Hi, my name is Paul, and welcome to the 24th episode of my monthly stock portfolio series. And the end of December will mark 2 full years of investing $100 of real money each month into Canadian securities. I do this series each month to track the ups and downs of investing in a mock TFSA that will never be maxed out, because I believe that I can show aspiring investors that even if you can only scrape together $100 a month or less, you can still achieve financial freedom over the long term, even if in the short to medium term, things look a bit negative. So, in this month's episode, I'm going to be giving you a quick recap of the key takeaways from Goeasy's third quarter earnings results. Then, I'm going to show you how the portfolio performed during the month of November, and you'll get to see exactly how I'm going to be investing this month's $100 and the dividends that were earned over the previous month. Now, before we get into the video, you should be aware that there is a link in the description box to the goals and rules that I've set out for investing within my monthly portfolio. But if you happen to be someone who prefers watching to reading, then you can also watch me go through everything in the first episode of the series. And a link to the playlist starting at episode 1 is also available in the description box of this video. With that, let's get into the news, which really was only Goeasy's financial results, and I've already got a video going in depth on their earnings, so I'll be pretty brief here. Jumping right into things, this was a pretty exceptional quarter for Goeasy, with huge growth across the board. The company underwrote a record $720 million of new loans, and the total loan book increased to over $3.4 billion, a gain of over 32%. And this performance came despite the company taking extra precautions like only accepting 15% of their loan applications and ensuring that a larger portion of the accepted loan applications were loans that were secured by collateral. This exceptional growth also came in spite of the company increasing their interest rates and closing down 4 physical branch locations. And all of these conservative measures resulted in a decrease in net charge-offs, or loans that won't end up being paid back, and a reduction of the minimum required amount that needs to be put aside for future expected unpaid loans. On top of that, the expenses grew much slower than the revenues, which helped the loan book growth translate into similarly strong earnings per share, hitting $3.81, which is a gain of nearly 30% when compared to last year's $2.95. Now, we did get more insight into the company's debt situation, and the company is still using debt to maximize their growth potential, taking out about $156 million in debt during the quarter. But according to the management, the company is able to sustainably pay for about half of their quarterly loan book growth without using any debt. And Goeasy is getting closer and closer to being able to achieve optimal growth solely from the net cash generated by the business. Plus, if the company did decide to focus strictly on paying down the debt, the company could be completely debt-free in under a year and a half. Though this would mean putting growth initiatives on the back burner, which probably isn't the best decision given the state of the industry. See, in addition to rising interest rates, the Canadian federal government has already put forth their plans to enact new regulations reducing the maximum allowable APR on loans. These 2 factors have been pushing out a lot of Goeasy's smaller competitors and have even been impacting the lending of the major banks, resulting in an influx of new high-quality customers for Goeasy. This is in large part why the management has been focusing on investing in growing their loan book with projects like the newly completed mobile app, which will bring in even more customers and loan applications, taking advantage of the company's high degree of operating leverage. But to do this optimally and efficiently, the company will likely need to continue taking on more debt for the near future. Finally, we got an update on the company's 3-year forecast, and while the numbers did stay the same, this is only because the management revises these numbers on a bi-quarterly schedule. However, the management expects that Goeasy will surpass their high-end guidance and that we should get some positive revisions come Q4. And the CEO also stated on the conference call that the midpoint of these figures project a mild to moderate recession with 7% unemployment in 2024. So, if a recession doesn't materialize, then the already strong guidance is probably a bit too conservative. But no one can accurately predict a recession, so just take all of that with a healthy dose of skepticism. And that was Goeasy's quarter. Really strong stuff there, and nothing really to complain about aside from the business risks inherent to Goeasy's business model and their debts, which I go over much more in depth in my dedicated video on Goeasy's Q3 earnings. And As I said earlier, there was no other news to come out for the portfolio's holdings this month, so let's jump right into the portfolio's performance throughout the month of November. Starting with the worst performer, MTY Food Group's shares declined from $54.38 down to $51.50, which is a loss of 5.3%. And last month, I picked up about 0.7 shares of the stock for about $38.60, which is now valued at $36.54. But at least we did get a quarterly dividend payout from MTY last month, so that did soften the blow a little bit. Next up was the Morguard North American Residential REIT, whose shares started the month at $13.71 and slid roughly 1.2% to $13.55. I purchased 5 shares of the REIT last month, and it did pay out its monthly distribution, which is always a nice little boon to the portfolio, even though the shares have continued to decline. And yet again, the best 1-month performer was Goeasy, which started the month at $116.68 and rocketed upwards to finish the month at $133.22, which is a gain of 14.2%. Now, last month, I once again did not buy any shares of Goeasy, and Goeasy's quarterly dividend doesn't get paid out in November. So because I didn't buy any shares of the one company that had a positive result, the performance of last month's investments was slightly negative if we don't include the dividends that were earned, and without the dividends, last month's invested capital declined by 2.65%. But with the dividends, the capital increased by 4.25%. Now, none of the benchmarked comparison portfolios earned dividends last month, but they do earn outsized quarterly payouts, which creates large monthly discrepancies. So I think it's generally going to be more accurate to just focus on the results that do not include the dividends. This, of course, leaves my portfolio's 1-month investments bringing up the rear, again, by a fairly wide margin. In second last was the Canadian All-Cap ETF, which put up a gain of about 2.51%. Next was the Global Value ETF with a gain of roughly 2.56%, and then the Canadian Large Cap ETF with a gain of 2.75%. Finally, the S&P 500 was the best performer of the month, growing by approximately 4.15%. Switching over to the total portfolio's performance, since the start of the series in January 2022 up until the market close on Thursday, November 30th, 2023, so far I've invested $2,366.21, which includes both personally contributed capital and the reinvested dividends. As things stand, the market price of the monthly portfolio's holdings have dipped to $2,028.08, which is at the very least progress over last month, and it also breaks the curse of not being able to finish a month above a $2,000 value mark to market. So, as of this recording, the current loss is sitting at about a quarter over $338, or about 14.3%. But as I keep saying, there hasn't been any new information to come out that has changed my conviction in these holdings. So, even though the short-term performance hasn't been ideal, I still think there's a lot of upside to be had over the long run. So, I'm going to continue taking these recent declines as an opportunity to accumulate more shares at what I believe to be a bargain price. Transitioning over to this graph, here you can see the portfolio's performance, net of contributed capital, represented by the green line, relative to the benchmarks and relative to my monthly goal line with the red stars used to show a 12% annualized rate of return. And as you might have guessed, things aren't looking so hot. The portfolio did manage to have a slight uptick from last month, but because of the growth of the goal line, I'm once again at the worst dollar discrepancy in the portfolio's history, with the difference now approaching $530. But on a percentage basis, I'm doing slightly better than last month since I now only need a 26% increase to get back on track instead of the 27% that was required last month. And after the past few months, any and all progress is warmly welcome here. But to progress further, I need to buy more shares with the dividends that I received from last month and with the $100 that I just deposited into the Wealthsimple account. My plans are to purchase 5 shares of Morguard, and I'll be putting the remainder into a fractional share of MTY Food Group, both of which I believe are unreasonably discounted and have a high probability of achieving strong long-term results. And to recap why I'm not investing more money into Goeasy shares, That's because I believe that the risks inherent to Goeasy's business are much greater than the alternative investments. And generally speaking, I try to invest in companies where I feel very certain about their long-term prospects. Though, if the price gets cheap enough, I won't shy away from what I believe are good odds on a somewhat risky investment. So, with that, let's get to investing. Alright, so I'm here inside the Wealthsimple account. It's Friday, December the 1st, and I have $107.69 to invest. So let's start off with Morguard, and I'm going to be buying 5 shares of Morguard. And we'll confirm that. And next I'm going to be buying some shares of MTY. It'll just be a fractional share and I'll get as much as I can. So we have $38.44. So we will buy all of that, confirm, and done. And that should come through in just a little bit. Okay, I've just received the email confirming that I've successfully bought 5 shares of the Morguard North American Residential REIT for $13.85 each, in addition to 0.726 shares of MTY Food Group at a cost basis of $52.95 per whole share, leaving my portfolio with no cash left over after my orders have been filled. So, as of the market's close on Friday, November the 3rd, the portfolio holds 107 shares of the Morguard North American Residential REIT worth roughly $1,489, about 8.9 shares of MTY Food Group worth nearly $473, and the same 1.62 shares of Goeasy, which are now worth roughly $224. Getting into the dividends, in November, Morguard paid out $5.82, while MTY Food Group paid out $1.87 for a combined $7.69 in dividends. That's enough to buy this set of Matchbox cars on Amazon, assuming you have Prime membership of course, and hopefully it'll make a good last minute gift for a car-loving kid who you forgot to include in your holiday shopping list. And during this time of year, every dollar not spent feels like its own little miracle, so it's nice that these dividends are actually able to contribute something, even if it's just a small gift. But over time, I expect that the portfolio will not only be able to provide enough dividends to pay for all of our gift obligations, but also all of the other living expenses that really tend to add up over time. But we're probably more than a decade away from any of that. However, since the portfolio's inception, we've now earned over $74.04 in total cumulative dividends, and nearly $57 of that came within the last 11 months, which is growth of over 333% from last year's $17 in earned dividends. Unfortunately, December is expected to be a slow dividend month with only Morguard paying out its monthly dividend. But it will be at the new raised rate, so I'm projecting that I'll receive $6.29 in the month. Noting that January and February should provide us with stronger dividend income thanks to the quarterly payouts from Goeasy and MTY. Plus, I suspect that both will announce a dividend raise to be paid out at the end of Q1. So we should be well on our way to surpassing a new milestone of achieving double-digit dividend income within a single month. Now, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no changes were made, I could now expect to receive $94.33, which is a 4.92% increase from last month, and that increased the yield on contributed capital by 2 basis points to 3.93%. And just really quickly before you go, I want to give everyone a heads up that next month's episode might be a few days late since my girlfriend and I are going to be traveling back home from visiting family and friends on the 7th, which is the day that this video would normally come out on. So depending on how hectic everything is, you can probably expect this video to come out somewhere on the 9th, but I'll do my best to try and get it out earlier if possible. Anyway, I hope you all enjoy the holidays, and that's going to wrap up this month's video. But before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities, So, again, I'm not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing with anyone else who might also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.